Welcome to a new episode of our Global Insight series. Today, we're diving into the recent moves by the Federal Reserve, our thoughts on market dynamics, and insights from our portfolio companies. We'll also touch on why small caps are uniquely positioned to outperform in the current environment.
For some time now, we have felt the Fed should have cut rates sooner, even back in June. From what we observed in earnings calls during the first half of the year, the Fed wasn't paying enough attention to key parts of the economy, particularly the lower-income consumer and small businesses. The 800,000 jobs correction reinforced our view. This 50 basis point cut sends a crucial signal to both the market and consumers. It indicates that the Fed is serious about working towards a soft landing. The rate cut shows businesses that relief is on the way, especially those hesitant to make capital expenditures in this tight rate environment. As small-cap investors, we often see early indicators that others might miss. For instance, we've noted a continued strain on the lower-income consumer. As an example from our portfolio, Savers Value Village, the largest for-profit thrift store operator in North America, reported that their U.S. business is stabilizing, but exposure to Canada's struggling economy is a headwind. Similarly, National Vision Holdings, known for its brands America's Best and Eyeglass World, reported that stretched consumers are delaying purchases. These trends are key to understanding broader market dynamics. Interestingly, the higher income segment of our portfolio, like Lindblad Expeditions, has shown little to no stress. Lindblad saw improving occupancy rates and yields, backed by affluent customers who remain largely unaffected by the broader economic headwinds. Meanwhile, our companies with global exposure, like PVH and Terex, are seeing mixed signals across regions. While Germany struggles, Japan and South Korea are showing resilience. In Australia, the rising rate environment is hitting consumers similarly to what we've seen in Canada, where all mortgages are variable rate. Looking ahead, we see real opportunity for small caps, particularly in M&A. Large cap companies are increasingly looking to acquire high-quality small cap firms for growth. In the last 18 months alone, 5 of our portfolio companies have been acquired, with others rumored as targets. Evercore, one of our portfolio companies, highlighted that private equity firms are sitting on $3.7 trillion in cash. LPs are pressing them to deploy this capital, which we believe will drive more M&A activity in the small cap space. So what does this mean for small caps? With falling rates, renewed consumer confidence, and rising M&A activity, we believe small caps are poised for outperformance. Thanks for tuning in to GIS Investor Insights, where we turn data into opportunity.